I think it's, and this happens sometimes in the housing market, you've got a slightly confusing picture of data pointing in multiple directions. And I think what you had this morning from the Halifax with figures that were just slightly under what were expected, I think that was probably the second crack that's appeared in the UK housing market after the budget. The first crack we saw last week, which was a drop in the number of mortgage approvals from October to November. So normally you'd expect, outside of mini budgets and financial crises, you'd expect mortgage approvals to climb from October to November. They fell. House prices are now sort of seem to be heading down. If you're looking at the Halifax, if you're looking at the Nationwide, they're still heading in the other direction. The overall picture, though, I think is probably some sort of slowdown is in the post, inevitably due to the fact that borrowing costs have risen since the budget.
But when you look at the numbers, do you see any sort of reason for concern, or are we talking about, let's call it, normal levels at the moment?
I think it's probably quite sustainable. We're not expecting house prices to crash next year, for example. We recently revised down our forecast, so they went from sort of around 3 or 4% next year, or this year, to around 2.5%. So we've just tweaked things down slightly. Our expectations have come down, given the sort of the more adverse lending landscape that we're now in. But I don't think it's kind of catastrophic, and I think 2024 has been a pretty low bar actually to compare to what happens next in terms of volumes and house prices. So I think there's more downwards pressure to come. People are still sitting on mortgage deals or mortgage offers that predate the budget, that were offered at 3-point-something%. You can't get those deals anymore. So that's sort of avoided a cliff edge happening in the market, and in the housing market it tends to happen, things tend to happen much slower. And at the moment, it appears to be slightly out of sync, but I think that slowdown is in the post.
And how are changes to stamp duty actually going to affect the dynamics here?
Well, the one thing guaranteed to affect behaviour in the housing market is a stamp duty change. If we look back over recent years, if we look back at the pandemic and the stamp duty holiday. So in April of this year, the zero rate band, where you don't pay any stamp duty, that falls back down to £125,000. There's a similar version for first-time buyers. Essentially, it means people transacting before the end of March are saving potentially several £1,000s, which is understandably focusing minds. So that is also another sort of force that's affecting behaviour and affecting people's decision at the moment. We would therefore probably expect to see a bit of a lull in the second quarter of this year in the housing market as people roll off, or those sub 4% mortgage deals start to lapse. And as the stamp duty holiday or the stamp duty change takes place. So you could start to see a bit more softness in the market from the second quarter of this year.
Interesting. The last time we spoke, I think it was around December 2023, so we were looking ahead to the outlook for 2024. Now that we're roughly a year after that conversation, what I'd like to understand is whether this is the moment for people to actually step into the housing ladder and actually purchase a home. Back then, you had told me that at the time it was a good time to buy because we were ahead of general election, so buyers could avoid that uncertainty. What is it like now at the moment?
Well, it's certainly a good time to buy if you can before the end of March. If you're in the market and looking, I think there's a ticking clock to some degree. In terms of what's happening in the broader market, we're not expecting, as I say, we're not expecting big double-digit movements in either direction. It's a fairly steady outlook in 2025. And beyond. Most houses are bought because people need to move for jobs and for schooling and that sort of thing. It's the discretionary element, I suppose, of the market that does tend to hesitate slightly when mortgage rates are above 4%, for example. People just hang on the sidelines a little bit more. And actually what we're seeing at the moment, those markets that are driven by schools and jobs and all the things that sort of affect daily life, they're actually performing okay. We expect them to come off slightly as mortgage rates do nudge up above 4%, which seems to be a bit of a psychological threshold. But those markets are performing pretty well, and people are sort of confident enough to step into the market.